As an investor, you have probably tried and struggled to beat the market. Most of us have been overwhelmed at times, especially when you realize the massive amount of analysis and research top traders do to find the best stocks to buy now. In this video, I'm going to give you a strategy that allows you to skip 98% of all that work by leveraging publicly available information. I've used this exact strategy for 6 years, and it's consistently found undervalued stocks you never hear about in the news until a few months to years later once they've had huge run-ups in price. Hello, and welcome to Investor Watch. Make sure to hit the subscribe button so you can eliminate hours of stock market analysis and get free content that will give you an edge. Most investors spend countless hours poring over data points like daily moving averages. The most popular are the 50 and 200-day industry or sector performance to invest in the industries likely to outperform. Value metrics to know what's undervalued. Things like PE ratio and PB ratio will tell you this. Also news stories so you can trade when the market sentiment changes, chart patterns, and more. Then the quote smart money or hedge funds. Use those, but also add in quantitative analysis, more computer and research power, and networking that could border on insider trading and collusion. With all this, it's no wonder that the majority of investors fail to beat the market and get anxiety when placing large trades and then become unsure when is the best time to sell a profitable position. But if you watch this video all the way through to the end, then you'll know exactly how to remove all this doubt and beat the market consistently. No investment strategy is 100% correct, and so it's important I give you the downsides of this strategy with the ways of how I get past every single one. The key is in letting others who have teams of researchers and a track record of success do all the stock picking and analysis for you. Why would you do hours of tedious work when it's already being done by others? You see, hedge funds that manage over $100 million are required to list all of their stock holdings. It's known as the 13F form and is filed 4 times a year. This gives us an inside look at all the smart money stock buys. Now you could simply copy them, and studies have shown this strategy does work to mimic the hedge fund's returns. But as you'll find out, there are big downsides with this strategy that you should know how to avoid. So what are the drawbacks of following hedge funds' positions this way? The first is you can get an incomplete picture of their portfolio due to short positions, which are not disclosed in the 13Fs. Secondly, you can get an incomplete picture due to time delays as the 13Fs are filed 45 days after the end of each quarter. Lastly, due to herd mentality of both retail traders and hedge funds, once one hedge fund buys a stock, others can pile into it, driving the valuation up to excessive levels. So how do you get past these and use the 13F to improve and reduce your stock research? First, do not look at the 13Fs of the following 3 types of funds: global macro funds like Bridgewater, credit funds like Cerberus. This is because most of their positions are not disclosed in the 13Fs because they buy large amounts of futures, commodities, bonds, and currencies. Also, don't look at quant funds. These funds' stock buys are determined by an algorithm, and so you have no real way of knowing why they purchased a particular stock. Instead, you should focus on looking at the stock buys of long-term investors with lower turnover. Although shorter-term investors' average holding period is longer than most people think at 1 year, the short-term traders are more likely to have already exited a position by the time their 13F is filed. Next, look at insider trades because they are disclosed immediately. If a hedge fund owns a large portion of a company, they are considered an insider. Activist investors often fall into this category. Next, look at funds with concentrated portfolios because they have low turnover. It's easier for a fund to exit a small position, and portfolios with hundreds of stocks will often exit and enter the smaller ones regularly. Lastly, focus on the fund's largest positions and biggest recent buys. These are their best ideas and often what they hold the longest, while the smallest positions are often used to manage net exposure to something they are actually short on. So if you see a small stock buy, you may think they are long that stock, but in reality, they are just buying it in order to short it. A common counter-argument to 13Fs is that they are just not valuable to look at. But in 2010 and 2012, Aufklum did an analysis of hedge fund returns and compared them to a portfolio just copying their publicly disclosed positions. The performance of the copy portfolios was almost identical to the hedge fund's returns in both studies. This is not what I expected. but it is consistent with what I've found when copying hedge fund stock positions myself. Also, hedge funds usually wait until the last day to file their forms. Why? Because it's valuable information. And lastly, my method of using these top investors to do my initial research and pick stocks with potential for me has worked for years, so I know it's an effective strategy. What exactly do you have to do to follow this stock buying strategy? Later in this video, I will reveal an easy way you can skip steps 1 to 4, but let me give you the entire process first. Step 1 is reading the 13F filings. Once one of the stocks is interesting to you, you need to analyze it and verify why the hedge fund bought that stock. To do this, look at the fundamentals, things like market cap, which is the current value of the company. This is truly the real price you are paying for the stock, rather than the stock price. Next is looking at relative valuation metrics such as P/E ratio, PS ratio, PB ratio. These don't indicate the stock is good, but rather if it's undervalued. Lastly, find any financial risks the company has. You can find these by looking at things like debt to equity ratio or debt coverage. Finally, find any other warning signs the company is in trouble. These include financial issues, but also any strategic or management changes you don't think are good ideas. Since you can skip steps 1 to 4, let's look at the research you should do yourself before buying any stock. First, find any news stories on the specific company you're thinking of buying. These often provide context into why the financials are the way they are, or what their strategy to improve them is. Secondly, listen to annual and quarterly calls of the fund. This will give you more insight into why they purchased the stock. And probably the most important thing for you to do is to have a strategy for your overall portfolio. Know what industries or sectors you want to own stocks in. This way, when 13F filings give you a great stock to look at, you already know if you need that industry in your portfolio, or if you already have some companies in that industry, it will make it easier for you to decide if you're going to look into it and how aggressive on getting the lowest possible price you'll be. The most time-intensive of all these steps is definitely steps 1 to 4. Lucky for you, I already go through the most important 13F filings for my personal portfolio, and I report the most interesting companies in each hedge fund on the Investor Watch YouTube channel. So if you want to skip the most tedious part of stock research and let top hedge funds do your research for you, just subscribe to the channel now. Go ahead and subscribe to the channel now. It's completely free and will give you the top stock picks the best investors in the world are buying right now. As an